Good morning. My name is Ron Bernbaum. I'm the CEO founder of PearTree Canada. Thank you for joining us this morning. I'm going to speak for about 4 minutes on an introduction, followed by 3 presenters, each talking about tax tips for high net worth advisors. We're going to be doing 7 tax topics in 40 minutes. It really is a tax advisor buffet. Leaving lots of time for questions. Any questions we don't finish or get to in real time, we'll be happy to follow up after the webinar. This webinar evolved out of a conversation among Mathieu Filion and Albert Lebel and Matt Fireman and myself about common, literally everyday questions posed by our high net worth clients. Hopefully your takeaway when a client mentions in passing, I'm buying a condo in Florida, the prices have come down, I'm going to retire. You can respond, have you thought about or gotten any advice on the impact of estate tax? So this is just to help you answer some of the questions, enough to be dangerous, but not enough to give advice, just enough to say, hey, I think you may have an issue and help out that client. But why PearTree? I think everybody on this webinar knows us for productizing the use of flow-through shares for donation and tax planning purposes. Our business, though, has been built over the last 18, 19 years on providing advisory. If in our discussions with high net worth advisors, financial advisors, and the clients or prospective clients, we come across a better solution for them, we will be the first to recommend a better solution. We know the space really well. We have one tool in the toolbox, but it's certainly not the only tool in that toolbox. There are many hours of courseware on our webinar, all tax-centric, most all of it not about flow-through shares. We're delighted to be working alongside Industrial Alliance. We've known many of the folks at Industrial Alliance for a very long time, but look forward in this more formal relationship to a long and ever closer working relationship. The 3 presenters, the first one is Katie Kaplan. She's a tax partner at BDO Canada. She's the Canadian leader of the high net worth tax practice. She's passionate about helping clients and giving back to community. She's currently a member of the Campaign Cabinet and Professional Advisors Council for Sick Kids Hospital. Katie's going to be talking about holding U.S. real estate and portfolio investments, income splitting, and business succession, all in 10 minutes. So, buckle up. Katie's in the GTA area. Claude Jodoin in Montreal is a tax partner at Fasken, who specializes in that convergence, that expertise in business finance, financial instruments, the purchase and sale of businesses. He's on the list of sort of the 10 lawyers in Canada that one would reach out to as on speed dial if you're doing a major transaction, especially if it were cross-border. When Air Canada bought Aeroplan, it was Claude who structured and then drove the deal team on that multi-billion dollar acquisition. He's going to talk about bare trusts, leaving Canada, estate planning, specifically with respect to the need for multiple wills. Followed by Raluca Grajdieru, who is our CFO. She joined us about 4 years ago, spent 7 years at a Montreal Uber high net worth single family office, and before that a chartered accountant at PwC. Raluca is going to talk about alternate minimum tax, AMT. Raluca's team completes hundreds of tax analyses every year for clients and advisors, and it'll be a bit of a deeper dive. I think you'll be shocked and probably fussed by the AMT impact. Spoiler alert, the capital gains inclusion rate wasn't rolled back to 50% last year. So that is sort of the end of the introduction, and now on to the substantive part of the of this webinar. If Katie can take it over from here. Thank you.
Thanks, Ron. This is a lot to talk about in 10 minutes, but it's a very good thing that I really like to talk fast. So I'm going to talk about 3 topics that are hot button items that we see over and over again that I thought would help you in working with your clients. So I'll start with the first item, if we can go to the next slide. Most of us have clients with US ties, and it's inevitable how close we are with our proximity to the US and how close our countries have worked together over the past decades. So one thing we need to remember is that the US is a very different country with a very different tax system, and that there are 2 types of assets that I want to specifically talk about today that impact all Canadian residents who have U.S. assets. And those are U.S. real property, particularly vacation properties, and U.S. portfolio investments. So some of you may know that the U.S. has an estate tax. So that is a 40% tax on the value of property for individuals with assets in excess of 13.6 million USD. Now, you might think, well, 13.6 million is really high. This is actually set to sunset on January 1st, back down to 5 to 6 million. And with the real estate, the values that it is today in Canada, generally lots of people who own a home and they also own a foreign property with some retirement assets, are exceeding this $5 million number USD easily. So why it's so pervasive is because it's a tax on the value. So if you bought something for $1 million and then sold it for $1 million, or the value was $1 million, well, in Canada, we would say there's no tax payable on that. But the US would say, please give me $400,000 because I'm going to tax you because it's an estate tax if someone was to pass away. So for real property, planning is often undertaken using trusts and partnerships to structure around this future estate tax for Canadian residents who are not US citizens. There are some nuances to this, but generally most can be successfully structured. So if you have someone who's buying a foreign property, make sure you're flagging this and having those conversations. There are a lot of nuances that have come up most recently, so just keep that in mind. Unfortunately, it's an ever-changing landscape, so there are some trips and traps still to be aware of, but generally still tried and true, and it does still work. The second asset class I wanted to discuss today is portfolio investments. So again, the same concept applies. And if you hold US investments in your portfolio in Canada, you can be subject to, or an individual can be subject to 40% state tax. Well, what is often done is, in order to get around this, those assets are transferred into a corporation and then held in a corporation. A corporation never dies, and therefore we're done. No US estate tax. Easier said than done, because the tax on the income earned is now going to be taxed at up to 11% more than it would have been if it was earned personally. So yes, you're getting around the 40% value tax potentially, but now you're layering on an additional 11% in income tax. So don't jump the gun. It doesn't mean don't do it. It does mean, though, you need to analyze every client situation and see what their use of the funds are. And is there other ways that you can get around this type of a tax without interlaying a corporation? So I do have a lot of clients that have either taken their portfolio into a fund structure or into some ETFs that mimic what they're currently doing. So obviously within the investment platform, it's just something to watch out for. But I would say, across my client base, I probably find at least 12 clients every year where there's some element of exposure here that hasn't been addressed. And it's pretty low-hanging fruit to deal with. And it generally is pretty high value to the clients when you bring this up. So I'm going to move on to the next topic, just because I have 3 topics to get through in 10 minutes. The next item I want to speak to is income splitting. Income splitting has been a hot topic over the past decade with lots of changes. And if anybody's been around and following tax for the last 10 years, there's something called tax on split income, or TOSI. And it reduced a lot of what's available from an income tax splitting strategy. 2 items I wanted to speak to specifically today on income splitting are in trust for accounts. We see these over and over and over again where people have set up in trust for accounts for their children or their grandkids. Keep in mind, income in these accounts is often attributed back to the parents or the grandparents, wherever the assets came from. And it is important that the correct SIN is used on the account. CRA is doing lots of slip matching, and there are a lot of nuances that are coming out of this. In addition, one thing that you just need to be careful of is these in trust for accounts, they might be caught under the new trust reporting rules. And if they're in express trust, having to actually file a trust return. Claude's going to speak a bit to some of the changes on the trust rules, so I won't go into this in detail, but just be aware that these accounts, which a lot of financial institutions don't love, they can cause, I'll say, a headache with some of the reporting and filing obligations. That being said, if these are structured correctly through inheritance or through wills or grandparents that fund these accounts and then the grandparents pass away, then attribution ceases and they can be a very good income splitting tool. The second item is prescribed rate loans. They're still an attractive way of splitting income via a spouse or a trust. The current rate is 3%. That will likely continue to fall as the rates fall. However, be cautioned that with this type of income, you're not generating a tax on split income issue. Again, you can loan money to a spouse or a trust, but it really depends on what they do with that income, what type of income they go and invest in and earn in order to determine, does it caught under TOSI, or can you really effectively split without strings attached? So again, still possible. The planning on this strategy is impacted again by minimum tax. You'll see there's an overriding theme here. And Raluca is going to speak to that a bit, just about minimum tax, but these strategies unfortunately can be limited to the amount you can do because of the new minimum tax rules. The last topic I'm going to speak about is business succession. So for those of you with clients that have a business, you're probably aware that on death, there is a deemed disposition of assets. It's a pretty generally well-known concept in Canada amongst advisors. To defer this tax a generation when looking to pass a business on, often an estate freeze is done to put the value into a trust of the business, giving the shareholders maximum flexibility for the future and where the value would be distributed, all while safeguarding against income tax liabilities. Kind of sounds too good to be true sometimes. However, there are caveats, and there are a few things I wanted to talk about when doing this planning that you might see clients and you might see their structures and say, oh, have you considered this? Or maybe we should think a little bit more about this other topic. So, and then a second use is obviously to multiply the lifetime capital gains exemptions, which is continuing to go up. So the three items that I want to, I'll say, walk everybody through, but also give you a little bit of caution as you're dealing with this, is the first, the pipeline plan, second, purification of corporations, and the third is where life insurance is ultimately held in a structure. First, for pipeline planning, when someone passes away, generally their shares or their business is going to be taxed at ordinary tax rates, at a capital gain rate, which in Ontario is 27%. However, in order to avoid a double tax, those shares must be either redeemed at a 39 to 48% rate or a pipeline executed. So although the capital gain rate is attractive, it's not so simple to access that final tax obligation of 27% unless the shares are sold to a third party. So it's just kind of making sure clients have gone through the process and made sure they're going to qualify for a pipeline through their estate planning, I think is very important, because the last thing you want to do is, if you're passing the business on to your kids, leave them with a very high tax liability that you didn't anticipate, or maybe don't have sufficient liquidity to cover, especially if you thought you were going to pay 27% and now your estate's paying 48%. When you're talking to your clients. The second item is around purification of a corporation. So when a business is sold, most entrepreneurs want to access their capital gains exemption. However, holding passive assets in that corporate structure that you plan to sell can put you offside of claiming a capital gains exemption. So a very good example relevant to this conversation is having a portfolio in an operating business or holding company. That asset often will set you offside and can set you offside from claiming the capital gains exemption entirely. The third item is life insurance. Also real estate we see sometimes too, but that's a little bit different. But if you see life insurance that's set up in the operating company or in the holding company to the operating company, and ultimately one day that holding company might be sold or passed down, generally that's a really bad structure, because you can put the client in a position where they either need to move their life insurance out on a taxable basis, really not great, cashed out, terrible plan, or they can't use their capital gains exemption. So making sure that when you're looking at who owns the shares of a business and everything in that, I'll say, linear ownership line is only good assets, no passive assets. So no. Generally, we don't like to see real estate in there. We don't like to see life insurance, and we really don't like to see portfolios in that sort of structure. So if you have any clients where that's where they're investing their assets and they own businesses, they really should be looking at moving that out and implementing other structures to put corporate beneficiary codes or other holding investment codes into their structure. And also it helps from a risk perspective, it helps diversify, but it can't stress enough how much it helps from the tax planning. So I think I'm a few minutes over. I apologize in advance. That was a lot to cover. And I will pass it over to Claude, who will talk about a few of the other tax items.
Thank you very much. I hope my camera's working. Good morning, everybody. So I'm going to be talking about 3 different topics this morning. One of them will be essentially dealing with the bare trusts and the controversy surrounding that. The second one, of particular interest to a lot of high net worth people, is the issue of either deciding to leave or not leaving Canada as a resident and therefore as a taxpayer. And the last one will be the issue of wills, and probably the best advice that you can give a client of high net worth, and we'll see why. We can change the slide, please. So basically, in case you don't already know, any trust in Canada is required, just like any other taxpayer, to file a tax return and pay tax on the income that it doesn't distribute to its beneficiaries. A bare trust has historically been an arrangement where one person holds title, but is not the true owner, if you wish, unlike a regular trust where the trustees hold that property for the benefit of beneficiaries. This person basically holds the property for the true owner, and the true owner is responsible for all income and gains and has essentially control over all of the assets. That seemed to have tickled our tax authorities in the wrong way. So back in 2023, the tax authorities provided for amendments to our Income Tax Act to essentially capture arrangements that would fall within the bare trust, or in Quebec, sometimes we call them a prête-nom, although that's a whole controversy in itself. But the implication is that any type of arrangement where a person holds property for someone else, whether it's entirely for someone else or partially for someone else, would be captured under this new notion of what they call a trust. And, whether it's an express trust, which is they deem, bare trusts to be a trust for some purposes, and then you have a few exceptions. But when you think of the kind of examples, so for example, if you have aging parents, and sometimes a child will help in the administration of the assets of those parents, adding the name of the child to the bank accounts or to other arrangements can actually create this bare trust relationship, which would give rise to this reporting obligation. Now, let's recall that 2 years ago, trust reporting was significantly expanded in terms of the level of information that was required to be provided. So originally, I think tax professionals didn't actually understand the extent to which this would be a difficult situation for clients, because all of those reporting obligations would now be transported into the context of the joint bank account, the mortgage in the name of the parents and the child in order to access the right funding to purchase a house. So all of those would have been captured under this bare trust arrangement. Could be as crazy as a corporation or a person that holds hockey tickets or baseball tickets for some areas on behalf of the other true owners. And that would be the double whammy when it's a corporation, because the corporation has to file a tax return, plus this bare trust arrangement has to kick in as also having to report on that. So the controversy essentially gave rise to a rethinking at the tax authorities level, and they came up with additional changes in August of this year, and essentially have postponed the filing. And currently there's no filing under the new rules for 2024. So basically we're looking at next year only, but they're full speed ahead, which is really an unfortunate thing, because when you think of the level of complexity and cost in essentially trying to report income, which originally was the announcement was they wanted to capture tax evasion and money laundering. I think it's a little naive to think that people that were actually in the process of avoiding taxes would feel compelled to report income in these bare trust arrangements. We can change the slide, please. The second element, and I'm hoping I'm not going over, the second element I'm going to deal with are essentially the concept of residence for your clients. So, who's not heard, I'm leaving, I pay too much tax, that's it, that's all. And so that's usually a knee-jerk reaction to an increase in the capital gains inclusion. You got your assessment, and all of a sudden you're saying, I got to be out of here. So changing residence is not for the faint of heart, because it requires essentially to tie all your residency and ties to Canada and acquire some somewhere else, because you can't just leave and not be resident somewhere. You need to be resident somewhere. So leaving Canada means you acquire residence somewhere else. There are a number of steps that are extremely comprehensive that have to be dealt with to cease to be a resident. And when you tell your client, well, you got to get rid of your house, your Medicare, your bank accounts, your driver's license, and the list goes on, then usually that becomes a little complicated. I have to admit, I've had at least 3 cases where clients have had 2 different residency status because wife and kids stayed behind. They were in school, father left. So that's something that occurs when there's someone who says, well, we have to rearrange because we think we're paying way too much tax. Now, one of the things to remember, if your client is saying that, you have to say, well, let's say you're successful in leaving Canada and you stop being a resident. What's the issue there? Well, the issue is you have a deemed disposition on most of your assets. So you're realizing accrued gain, except for a select few, and now you're going to have to deal with that before you go. In the year of departure, you pay tax on your worldwide income up to that date, but you also have to realize accrued gain. As an investment advisor, you know that number. So you're going to say, well, let's see what happens here. You got to make some planning and you have to calculate. Additionally, when you get into the next jurisdiction, you find yourself, well, you're now a non-resident, and there's a number of assets that you may still have in Canada. Investments, RRSPs, rent, if you own buildings, and those would all be subject to withholding tax at 25%. So having that tax continues your ties to Canada from a taxpayer's point of view. And you have to be in a jurisdiction where you can use the tax as a foreign tax credit. So that's not always obvious. Selling property after you cease to be a resident, much more complicated because you have this reporting requirement and certificates. So this to say, if your client becomes serious at leaving, there's a lot of planning that goes into this. Make sure that it's done in an orderly fashion and that they're not finding themselves essentially whipsawed where they're taxed in both jurisdictions and the tax is not fully covered by foreign tax credit. Now, the last part here is the risk of acquiring residence in another country. Now, as I said at the beginning, it's difficult to lose residents from Canada. They like to keep their mitts on their clients. The fact that you're traveling will not make you lose your residency in Canada. So a lot of people, have that unfortunate misconception where they think, well, if I travel too much, I'll lose. No, you're not going to lose residents from Canada. They like you too much. What will happen is that you may find yourself in a jurisdiction where they also think you're a resident. That's the key. You have to make sure that you look at that. And if you fall into a jurisdiction with a tax treaty and you've been there for 7 months and they say after 6 you become a resident, tiebreaker rules, if you have a treaty, will determine where will most of your income be taxed and how it will be taxed between the two. More complicated if you end up in a country where we don't have a treaty. And there's several of those. So they're very attractive from a climate perspective. Unfortunately, from a tax perspective, you have to be more in tune with that. I think it's time for the next slide. Now, that's what I was saying. This is the best advice you may have to tell people. If you're dealing with people of wealth that are Canadian residents, the possibility that they own assets in multiple jurisdictions is very high. I mean, at least all the clients I've seen, they always have assets in so many jurisdictions, and you're going, well, you can't have one will, because if you have one will, it's going to be complicated, because you need to have a will for every country where you have assets. It makes it easy to administer. It reduces costs. So we talk about probate fees. Many countries require probate, which is the way, it's a process to go before the courts and have the will recognized as the proper instrument for your devolution of estate, and to see that the assets will be transferred in an orderly fashion in accordance to law. So not having a will in a jurisdiction where that asset is located will require you to bring the will there, go to the courts, and there may be difficulties. For example, if you have inserted in your Canadian will a trust, the creation of a trust, a usufruct, a life interest, you have to be careful. Some of these concepts are not, don't exist in other jurisdictions. So you have to make sure when you're making a will in another jurisdiction, you follow those rules. So doing that will essentially will avoid that mistake, which could be very costly. Right? The notion of having several wills also is important if, for example, you want to determine which assets will be used to pay the debts of the estate. If you want to have different executors, you're saying, well, in Costa Rica, it's Mr. So-and-so. In Montreal or Quebec or Ontario, it's Mr. So. It's another person. That ensures that you have that right administration of the estate. Additionally, you may want to have, let's say, several wills, because if there's a challenge by some beneficiaries or other persons to a will in one jurisdiction, it won't affect the others, right? So it's always important to consider the bigger picture. Finally, as we're about to take me off, make sure that all your wills are properly coordinated so that one actually doesn't cancel another. Thank you very much. Was that 3 minutes? My time?
Thank you, Claude. Thank you, everybody, for joining us. I'm going to briefly talk about capital gains in the AMT. So AMT is a hot topic ever since the 2023 budget, when the federal government has brought in a bunch of significant changes to the calculation. So what is alternative minimum tax, or AMT? It's a parallel calculation of tax payable. So on your T1 return, which many of you may be familiar through your own personal returns, is where the regular tax is calculated. And there's another schedule in the tax return, the 691 schedule, where the minimum tax is calculated. The taxpayer will pay the higher of the two amounts. So for example, if your regular tax is 100,000 and your AMT amount is 120, you will end up paying $120,000 in tax that year. Now, that $20,000 difference is not lost. It can be absorbed within the next 7 years to reduce your regular tax payable, as long as there is room, i.e., the regular tax is higher than AMT in that year. So let's say this year you have $20,000 of AMT carried forward, and next year your regular tax is the same 100,000, but your minimum tax is 90. So you would have $10,000 of room where you can absorb the AMT carried forward. Now, obviously, you had 20 to carry forward. You can absorb 10 in 2026. You'll be able to absorb the other 10 in the following 6 years. So you will see, and I have an example later on, that the 7 years is not always sufficient for certain taxpayers to absorb the carried forward amount. And so it will be completely lost. I also want to mention that AMT at the federal level, so let's say if you have this $20,000 at the federal level, it would also imply that you have a provincial AMT. in any other province other than Quebec for now, because the provincial AMT is actually a percentage of the federal AMT. So the moment you have federal AMT, you have automatically provincial AMT. Now, in Quebec, Quebec has harmonized with the federal rules. So they also have a separate alternative minimum tax calculation, which is a separate schedule in the Quebec return. They've taken most of the changes that were introduced in the 2023 budget with a few changes in rates and amounts, but primarily they look very much the same. We can move on to the next slide, please. So what are the AMT mechanics? So AMT is a little bit more complicated when you look at the return, but it's basically the same calculation as a regular tax. So you start with your income, your deductions, you have a deduction for personal amount or a basic exemption in this case, a tax rate, and some credits against that tax payable. The way that it starts, so AMT starts with the regular tax or the taxable income from the regular tax calculation. So on your T1 return, you'll start with your employment income, your dividends income, investment income, et cetera. Then you have certain deductions against it, such as RSP, childcare, carrying charges, et cetera. And that's your taxable income. That is the number with which the AMT calculation starts. And then the government said, well, we after the 2023 budget, they said, we're going to reduce some of the deductions that we've given you under the regular tax. So for example, childcare expenses, let's say you had $10,000 of childcare expenses on your regular tax that reduced your income. They said, well, no, we're not going to give you the whole 10,000. We're only going to give you 50% of that. So you only get 5,000 deduction on the AMT. Therefore, we're going to add 5,000 to the AMT base. Another big one is capital gains. So as Ron foreshadowed, the capital gain inclusion rate has changed for AMT purposes. So effectively, it's not really 50% for certain individuals, but you'll see that a little later. So on the regular tax calculation, your inclusion of capital gains is 50%. But for AMT, they said, no, we're going to include 100% for you. So let's say you have 100,000 capital gain, 50 would have been included in your regular tax. But in AMT, you include the whole 100. So there's, again, a $50,000 addition into your AMT base. So once all these adjustments are taking place, you will deduct $173,000 of basic exemption. Now, the government deemed this amount to be such that AMT will not affect most of Canadian taxpayers, because they said most of Canadian taxpayers will not have income exceeding $173,000. And the whole raison d'etre of the AMT is to basically make sure everybody pays their fair share, but primarily to target high net worth individuals who would have had access to tax saving strategy and could have potentially brought their income down to zero. They're saying, no, everybody has to pay a little. So that's why AMT exists. And then they said, well, with this 173, we're still only targeting the high net worth individuals, which we will see it's not always the case. So after you reduce the income by the basic exemption, you apply a flat rate of 20.5%. And after that, you reduce it by credits. Again, here, based on the 2023 changes, they're not giving you the same credits under AMT as they give you under the regular tax. A big one being the donation receipts. So for example, you make a cash donation, your donation credit on the regular tax is $10,000. On the AMT, they said, we're only going to give you 80% of that, so $8,000. The other credits that would have been the non-refundable credits under the regular tax are only 50% allowed under AMT. So all in all, through the 2023 changes, what they've done is they've now brought AMT closer to the regular tax payable, making it more likely for you to fall into AMT. If we can move on to the next slide, please. So just wanted to go through a quick example just to show you the impact of AMT on someone who is not considered a high net worth individual, but who has had a life event. So here we have Jane. She's 75 years old. She's downsizing, maybe a widow. She had a vacation property that she bought it for $250,000. Real estate prices increased. It's now worth $1,250,000. She decided to sell it and maybe lift off the proceeds, so she'll trigger $1 million capital gain. Under the regular tax method, as mentioned, she would have a $500,000 taxable income because it's only a 50% inclusion, and she would have paid $224,000 in tax. But under the minimum tax rules now, she's paying tax on the whole $1 million because it's 100% inclusion. So now her minimum tax is $265,000. She will have to pay the higher of the two. So there's a $41,000 excess tax that she's paying on the sale of this cottage. Now, if her income otherwise is $50,000 a year, she would have paid $7,500 in tax a year. So she's going to be able to absorb that tax, that excess tax, in 6 years, which is not ideal given time value of money, but she can absorb it, so it's not a loss benefit to her. But immediately she has to pay the $265,000. Now, as you see, the inclusion rate for her went from effectively being 42% to 50%, and she has $1 million capital gain. Now, if we look at the next slide, for those who have gains above $5 million, the capital gain is actually much higher than 50% through the mechanism of AMT. So although under the regular method, it is a 50% inclusion, and the government said we're not increasing it to 66 2/3 until next year, by making the changes to the AMT amendment, by not backtracking on any of those changes, they have effectively increased the inclusion rate on capital gains. So for gains above 5 million, in Ontario, you're up to 58%. In Quebec, you're all the way up to 66%. Now, if we go to the next slide, I just wanted to finalize with Jane as the example. So again, they said it's only the high net worth individuals that are being affected. Nobody else should worry. But Jane, as many people who have a life event, want to donate money to charity. We see this a lot at PearTree, where people dispose of an asset and are charitable and have the opportunity to make a significant gift. So let's say Jane wants to donate $200,000 of her proceeds to charity. Under the regular tax method, she would have paid $123,000. Under the minimum tax rules, because again, it's $1 million that's taxed on the capital gain, and she only gets 80% of the donation credit under AMT, she actually has to pay $183,000. And since she pays the higher of the two, her tax bill is $183,000. This means she has $59,000 of excess cash, the tax that she needs to pay out. Now, if we look at her again and we say she will only make $50,000 a year for the foreseeable future, she will actually not have time to absorb the entirety of it because she will need 8 years to absorb $59,000 of AMT carry forward, but her maximum time allowable is 7 years. So she will effectively not take advantage of the carry forward period. So this is just to say that AMT, while it's supposed to be about tax fairness, it doesn't feel like it's always about tax fairness. And there are individuals with life events who are not necessarily highly taxable from an income perspective that do fall into AMT and are penalized by AMT. Thank you very much.
Well, thank you, Raluca. Thank you, everyone. I think now maybe we can all come on the video. Maybe we can answer some questions and some comments. The first one that's come in, I think, is back to you, Katie. Maybe you can put your cameras back on. So let's give it a second where everybody logs back on. There you are. One question's come in from Alberta that's asking about whether in a corporation that's distributing a capital dividend account, so that there's a payment to a shareholder under the CDA, which is tax-free, are there any restrictions in giving that money away to your children or spouses just as a pure gift? I mean, is there an avoidance of the TOSI rules as a result of just taking in a $500,000 of CDA and then simply paying out cash to your kids if you choose to do that?
So gifting money to adult children will never have attribution apply whatsoever, and you're always okay. But anytime you're gifting money to a minor, even if it's from capital property, you still have to be aware of TOSI. if the implications of it. So you're not going to get out of it per se that way. The other thing I'd say, the other thing I'd say to be careful of is with a spouse. Generally, any loan to a spouse will attribute back to you. There's some pretty fancy planning that can be done on some of this to, I'll say, get out of attribution, especially where, let's say, shares are donated, where the capital gain wouldn't attribute back because there is no capital gain if it's public market securities. And so I've had situations where some spouses have transferred shares to a spouse that would eventually be donated in the future. So I'll say there are some nuances, but generally speaking, you are going to be into TOSI or tax on split income.
Terrific. A question about bare trusts, Claude, I think, and that is lawyers' trust accounts, bare trusts, not bare trusts.
Technically, no. Actually, technically, yes, but a rule is there to exclude it, but it's not clear because if it falls in our general trust account, it's excluded from the bare trust. Whereas if it's held for a specific client, there is a possibility that these rules, which are a little bit unclear, may capture it. And then there's the issue of solicitor-client privilege. So not resolved entirely. We think it is, but our friends at the tax authorities somehow don't agree.
You have friends at the tax authority?
No.
All right. More Q&A. Oh dear. Budget. Anybody want to say anything about what their gut feeling is about the upcoming budget?
No, it's 4th of November.
Pardon me?
It's November.
4th of November, that's what we can say about the
That's
budget.
November the
Oh, no.
Okay. Is that that's your own tax avoidance question? All right. Katie, anything? No, anything keeping you up at night? Anything doing like late night structuring that deals with issues?
Yeah, I'd say that in advance of any budget, generally anybody that's got a pending transaction wants to execute it before that budget date because you never know what will be in it. We just released our pre-budget commentary, which basically says a whole bunch of, what ifs, and I can share that. Effectively, if you have the ability to get something done, do it. Don't wait because you never know what it holds. But I like to be a little bit of an optimistic person, and I hope that there's not massive changes that are negative for taxpayers.
Yeah. I mean, unfortunately, the last 2 years federally and most recently in March in the province of Quebec, the budgets were surprise. Oh dear, are they serious? For those who don't know, PearTree is a registered lobbyist, both federally and in Quebec. And I think we've given up in Ontario because we've basically given up on lobbying Ontario. There was something said in finance a couple of weeks ago that gave me a little bit of heartburn. And I've often thought that AMT might be applied to CCPCs, to private corporations. And I'm afraid to say it, but our advice, we are never fearmongers, but for our clients who historically like to wait until the very end of the year, we're saying it we think it's just prudent that if you're otherwise going to participate in what we're doing, you should do it before November the 4th. And so we're working hard assembling that inventory to ensure that actually happens before the 4th. So I think like you, Katie, we're telling everybody, no worries, be happy, but you have cause to maybe not be so happy. Are there any other questions? I can't see all the questions that have come in. Our phone lines are open. If somebody wants to collapse their corporation that's worth $2 million, assume all the costs, so $2 million sitting in cash, is there a way to pay it out in dividends and then buy flow through and pay AMT? I'm not exactly sure I understand the question, but it's from an anonymous attendee. Anybody want to decipher that for me and answer it? Will the average rate go down to 20 to 25% for this redemption? So
I can chime in a little bit.
Okay.
It's going to depend ultimately on your tax attributes, but effectively, just caution about using flow through to shelter dividend income because you want to use your dividend tax credit And if you don't use it, you lose it. So you wouldn't want to have use flow through to shelter it and then forego your dividend tax credit. And dividends, depending on if it's an eligible or an ineligible dividend, will depend on the effective tax rate. And so you can run up into a situation where if you tried to shelter it all with flow through, then you could end up with I'll say you likely will end up in a situation where you will not be able to use all of your tax credits that would be foregone. So that doesn't mean it's not still a strategy to look at, but it would need to be done on a more fact-specific basis with what type of dividend it is, what the other income is for the taxpayer, and looking at what that optimal number is to shelter.
Okay. There's a question about AMT, and thanks. I think I understand it now. The question about AMT and terminal year return, year of death. Is there AMT on
There is no
terminal year
AMT
return?
in the terminal year return. Also, there's no AMT currently in corporations. So let's hope that stays the same.
And in the year example, Raluca of Jane, I'm just reading a thing. And Jane, if she has a carry forward, if it's not fully utilized, should she be applying for MAID in year 6 or 7? And is there a carry forward of the AMT credit into the terminal year return where there is no AMT?
I believe so.
Okay. Anybody think otherwise? Okay. So the good news is you can use the credit. The bad news is in most instances you better die in the next 7 years to use it. We have found that so often individuals that have a major financial life event, they've sold a property, they've sold a business, it's whatever, and they have $10 million of proceeds and they want to make a donation. They're never going to have enough subsequent income. I mean, if they want to make a $2 million donation, they'll never, ever have enough subsequent income to use up all the credit. It just won't happen. And so that's been most people now, and Raluca can attest to this because she does the calcs, or her team does the calcs. More often than not now, people will say, well, how much can I give without falling into AMT, notwithstanding the fact that I want to give more. The fact that there is an AMT clawback for a donation as an alternative minimum tax, that's something we've been lobbying about for a long time. To tax people on generosity doesn't seem right. Another question: if clients hold U.S. stocks in a Canadian non-registered portfolio, are you suggesting they should have a U.S. will?
For publicly traded stock, likely no, because there's no issue that should arise there. It's more for real estate and things that are really located, in the jurisdiction. But if you're looking just at publicly, U.S. public stock, I don't see the need for it.
What about situations where so many high net worth clients are participants in U.S. Private equity funds?
Yes. Well, that's a different issue because there, depending on the structure, because your client may not be holding it directly, they may hold it through a U.S. corp. So you may have there an issue or a partnership because you may end up having to file in the U.S. So in those cases, we actually do get a U.S. will for that part.
I would actually challenge the structure on that too, to say structure it properly. Because now you're not going to, you might be into U.S. estate tax, and by simply moving who owns that U.S. investment would also address the will commentary, because now it's not owned by an individual, and U.S. estate tax at the same time.
Okay. Question about whether capital dividend account can be used to redeem the free shares as opposed to just redeeming them out and paying tax on that redemption. Katie, do you want to speak to that maybe?
Sure. I mean, using a capital dividend account to redeem out free shares is always a great strategy. Generally doing a wasting freeze to reduce any tax on the death of the, I'll say, first generation or the current generation who holds the preferred shares. So it works. It's often used. And then ultimately you effectively can get to a situation where you have maybe no tax on the preferred shares as they've been redeemed out over time. You have to be careful using CDA on those preferred shares if it's part of an estate or insurance that's paid out as a part of death, because you can end up into the stop loss rules, which will prohibit how much you can effectively carry back if you try to redeem the shares with what CDA has been claimed. So there is some nuances. If you won't, in effect, the rules are designed that you won't be able to do it all on death. But if you can do it during lifetime, it's a great strategy.
Okay, just to step back a little bit, because we're talking in acronyms, I think, a little bit. So CDA is capital dividend account. It's simply if Claude owns a share that he bought at $1, he personally owns it and he sells it for $101, he has a $100 capital gain. Forgetting about AMT for a moment, he takes $50 and he puts it in his pocket. The other 50 is added as income in the T1 return. A corporation is supposed to be treated exactly the same way under the integration rules. So if Claude Co. does exactly the same transaction, Claude Co. may not necessarily be just owned by Claude. So that $50 free portion of the capital gain has to be notionally accounted for, and it's called a capital dividend account, or CDA. And CDA is always valuable. I mean, some advisors will tell you, no, it's not. We have lots of capital dividend account that we're living off of. In our experience, and certainly in the experience, I think, of both Claude and Katie, there ain't never enough.
It's tax-free money.
Pardon me?
It's tax-free money.
Get it out, even if you have to lend it back in. And then it gives you the ability to earn interest at a personal level if you want to then shelter that personal income. That said, on capital dividend account, well, I guess one is looking at another question. What does this? Oh, okay. So we need some clarification on the freeze. So let me see if I can explain it a little bit, because of course there's a bunch of questions coming up as it relates. So generally, mom and dad's generation, they've been successful over 15 or 20 years. They do evaluation of the business, and they say the business is worth $10 million, and they're going to exchange their common shares for pref shares, and set up a holding company. And then any future accretion drops to the next generation. But there's $10 million of pref shares. Mom and dad die. There's a deemed disposition limited to that $10 million. So the estate value of the company has been frozen at $10 million. Using the capital dividend account, we do this at PearTree all the time, because wherever there's a capital gain and flow through, there's always a capital dividend account. And so the recommendation is eliminate those or redeem those pref shares, so that over time there are no pref shares outstanding, that the free shares are gone, and you've just saved tax on $10 million of deemed dispositions on death. It's astounding how often there are shares that are still outstanding, that on companies that were frozen 15 or 20 years ago. Any additional comments by either Claude or Katie on that before we move on, if there's anything to move on to?
Well, the only thing I would add, which is going back to the CDA account, given the looming budget, I think it would be a wise strategy to make use of the CDA account now, because who knows what happens. If there's any kind of change that affects it, it'll be too late on November 4th.
Oh, great. Another late night.
Yeah.
Okay. Changing topics for a minute. I'm just going to read it out. On terminal return, what tax strategies are available for non-spousal beneficiaries of RSPs and or RRIFs for high-valued portfolios, $500,000 or higher? It's like Jeopardy. I'll take terminal year returns for 20, Art, please.
Anytime you can do a donation that can be claimed in a terminal return is ultimately going to help offset an income tax liability. The reality is that unfortunately you are limited with the ability to shelter items from an RSP or RIF after someone's date of death, because once they pass, the income has been included in their terminal return, but you can't transact or do anything from the estate backwards unless it is by virtue of donations. That's kind of the one caveat. So one of the other questions actually earlier up to kind of touched on this, but what some people do, and I do have clients that are actively taking their RIF out prematurely because they're planning to do some pretty large donations and saying, well, if I'm going to pay tax, I might as well, try to shelter some of that now through some donation planning and ultimately do it now versus in the future. So that is actually an interesting analysis, and it comes back down to time value of money analysis as well. It's not strictly a tax strategy, but that is actively what I've seen clients do to try to shelter that.
Yeah. As a matter of fact, I think somewhere on our website is another presentation we did 4 years ago where a chartered accountant in Vancouver by the name of Hugh Woolley actually had written an article that we then talked about called your RSP or your RIF is a ticking time bomb. You're paying full rate on what is essentially capital gains over the years, and get it out while you're still alive. And he did the math based on all of that. I'm just looking to see how our time is. We only in the last couple of minutes. Okay, here's I think you also have Katie and Claude and Raluca. You also have access to the questions. But Parent 81 owns a holdco that is used for investing in public companies. Parent has willed the company to their son. All loaned in capital has been repaid over the years. Holdco has $1 million and paid gains every year as income. Is there a tax efficient way to transfer Holdco to the son prior to death? If the answer is no, just say no. We're now.
Yeah, I'm reading it through again. The answer, in reality, the answer is no. The value is sitting in the individual's hands, and it's a taxable event when the transfer is made. Full stop.
Okay, there are, I think, 4 or 5 other questions, also a husband and wife and holdco, but I think, or maybe we can, is there anything on there anybody want to look at in terms of the last,
Sorry, just one thing, Ron. The only one thing I would say to that last question is you can freeze and deal with future growth, but that doesn't help,
That doesn't help, no, not, and it's just probably the securities.
Yeah.
I understand that Industrial Alliance will be making this webinar available to its clients. Let me end with going back to law school. This is, you can't rely on anything we've told you today, right? This is not tax advice. Claude is I did this because Claude told me to do this, and oh my goodness, and hello Fasken. And so I just as a disclaimer, and we don't like posting disclaimers on these webinars because who reads them anyway? The obligatory disclaimer. But I should tell everybody that, the bottom line simply is client mentions one of the topics we raised today. You'll want to say, you really should talk to a professional about getting some advice just to make sure that you don't accidentally wake up one morning and go, what do you mean or your kids wake up one morning and what do you mean I have a $400,000 estate tax bill in the United States on $1 million condo? And I think with that, we're done for the day. Thank you, everybody, for joining us. Thank you, Katie and Claude and Raluca for doing all this. And hopefully we'll continue on maybe with something else for Industrial Alliance in the near future. Every one of the topics we discussed today could have been a 2-hour presentation. Right? If you want to get down into the weeds, we're good at weeds. On that, Laura, if we can call it a day, we're done. Thank you so much for joining us. Bye.